Hey, I hope you're all doing well out there. This is your May market review. So, for those of you that aren't familiar with me, my name is Dan Westfall. I'm a certified financial planner. I run Client Focused Financial. The reason I put these videos together each month is to give my clients the straightforward information about what's going on in the stock market, the economy, and then ultimately how that affects their investments. So I do this through using a lot of different visuals like charts and graphs, just because I feel like that gives people a better grasp of some financial concepts and really gives a visual to what's going on in the stock market and the economy. So I got a number of graphs here that I'll go over initially. So for the first chart that I have, it's just a simple chart of the S&P 500, the rate of return through May the 4th, which we're up 6%. For the year so far, rebounding a lot from the March lows that we had just before I made the last video for the April market review. So for those of you that have been with me for a while, those are just normal bumps that happen along the way. While it might be because of a bigger conflict and it's a huge news headline, inevitably stocks are always a forward-looking vehicle really to invest in for the future, because an investor doesn't necessarily care about what's going on right now collectively as a whole. It's more of, well, what is a company going to be making in the future? So again, another little ripple effect that stocks had, which we kind of worked through. So it's definitely one of the things that it's been a common theme where stocks have been moving up and down like this over the years. I looked back to see last year there was the announcement of tariffs right around the end of March, beginning of April. Just like when we had this drop this year, it seemed like almost in the exact same time frame. The year before that, in 2024, I had to kind of look this up because 2024 was also a really good year. Stocks were up for the year about 25% on the S&P 500, but there was a point in time, just like what we had here earlier this year, where the stock market, the S&P 500, was down 8%. So in 2024, there was a global policy shock that the Bank of Japan had raised interest rates and strengthened the yen, which forced an unwinding of the yen carry trade, which just was a liquidity shock basically on markets as a whole. It caused the S&P 500 from mid-July of 2024 through the beginning of August to drop about 8% as well. So there's a theme here that's happening. Last year in 2025 with the tariff announcements, markets were down like 10-15%. So there's a theme that happens where markets sell off because of some major news event and then inevitably rebound back to new all-time highs. So I was interested, and I want to look up this stat for you guys to see how often the stock market is at all-time highs or near all-time highs, because I know it's pretty frequent, but just as somebody that's not in the weeds every day, I thought it would be really impactful for you to understand like how often stocks are very close to all-time highs and how normal that actually is. When we hit an all-time high, there's a 75% chance that stocks a year later are going to be positive. So that's a little bit higher than any other day, where it's roughly about 72% of the time where stocks are higher over a year, if we fast forward then a year later. So I bring this up just because we're right back to all-time highs, and some of the people that I've heard from are like, man, stocks are really expensive. And I always use, it's always relative, because, what are they expensive to? I mean, are you just thinking because they're at an all-time high that they have to be expensive because it's at a high? And, these stats kind of prove that really all-time highs are actually great opportunities to invest money, because typically a new all-time high leads to a future all-time high. So statistically speaking, there's just, it's positive a year later, 75% at a time versus 72. The average rate of return on any day when we fast forward a year later is about 10%, which that's the average for the stock market, generally. over on an annual basis. If we look at all-time highs, though, the average is about 12%, so a couple percent higher in those time frames, which just kind of goes back into the fact that all-time highs typically lead to new all-time highs. 30% of the time, just the last little stat here for you, roughly 30% of all-time highs in history, roughly 30% of all trading days in history are within 5% of an all-time high. So highs are normal. It's not an extreme that should be something to be overly concerned about. Really, it's a way that you as an investor are getting rewarded for the risk that you're taking in those time frames, like what we just had here a couple months ago. It's also a reminder as an investor of why you stay invested, and you don't just freak out and pull money when there's a little bit of a bump along the way. So my role for all my clients is helping managing their portfolios, which a couple of the trades here that I made more recently, I'm going to pull up. But my role is really helping kind of like maneuver money within different opportunities that are happening to help my clients take advantage of these market imbalances that happen. I rarely am going to be putting people's money in treasuries or something on the sideline, so to speak, to try to avoid a drop, because inevitably, if there is some type of drop, more than likely there's going to be a rebound from that, in some period of time. What might not be as quick as what we just saw here, where we just ripped to new all-time highs in a pretty short time frame, but it's more frequent for that to happen than for stocks that just keep plummeting. So my role, though, is just kind of maneuvering money around to help my clients make more money. So a couple of the trades that I made more recently, the biggest one that I made, actually, when was this? April 14th is when I made this trade. So 35% of the sector rotation strategy, which is my more aggressive investment strategy, I took the technology sector, which made up 35% of the portfolio. At the time, semiconductors was only about 6-7% of the portfolio. I increased that to 35%, replacing technology completely with that segment, and added it to areas. Took a couple percent, added to Bitcoin as well, which is an area that's done really well. But semiconductors have done even better. This chart that we're looking at here is a chart comparing the S&P 500 in the orange to the technology sector in the blue to the semiconductor sector in the purple there. So technology's done really, really well in comparison to the S&P 500 since I made that trade mid-April. But really the reason that I made that trade was because semiconductors were in a breakout, and they've continually moved higher, from that point, outpacing just the general tech sector by about 4%. Actually, if we include today, probably closer to 4%. So I'm shooting this on May the 5th, just to give you, proximity. So really good trade. It's something that, I'm looking at, seeing where that can actually continually keep moving, because semiconductors are a huge benefactor of the AI movement, which has been a huge, momentum trade within the overall stock market, with a lot of these companies within inside of that fund doing really, really well as they reported earnings. So that's something that, I want to keep people's money invested in that to help make above average returns within that part of the portfolio, and reduce some risk if I can at the same time. So that's been a good winning trade so far. Only been about 3 weeks, but working out well. One of the other trades that really was a position that about a few weeks ago I was considering cutting, because it was a win, but it was something that was slowly being eaten away with oil prices moving down because of the Iran conflict kind of coming to a little bit more of a close. So that was the energy sector, which in this chart I'm showing you the S&P 500 from February the 5th, which is when initially I had started that position, cutting healthcare, which healthcare is actually negative in that time frame. But I took that money, that 10% that was in healthcare sector, and put that into the energy sector, which has done 14% since that time frame. There was a point, though, here a few weeks ago, you could see where it kind of almost descended to where it was getting closer to a break even with the overall market, which I wanted to lock in those gains. But inevitably, I think oil and not necessarily oil, but energy companies specifically are going to continually keep breaking out because not just because of the Iran conflict, but because they've been in such a long trading range prior to that, which I've talked about in previous videos. So, we're just kind of benefiting from the fact that, it's finally breaking out at this point. So, not necessarily a spot that I'm going to sell right now, although obviously it's something that I keep a closer eye on. It's 10% of the sector rotation strategy, which energy only makes up about 4% of the S&P 500. I thought this chart was kind of interesting just to see the correlation and visualize that of the S&P 500 dropping down because of the Iran conflict. At that same time, energy, peaking, from a rate of return standpoint. So since then, a really good thing to see was after that convergence in mid-April is that while the S&P has gone up, so is energy. So that's really what I want to see from a technical standpoint is that, continued strength within energy. So definitely something that, I'm going to keep an eye on moving forward, but, one of the early wins so far this year. So those are a couple of the bigger, trades that have been done more recently. The semiconductor one being the biggest one last month. So, versus and swapping out the technology sector. So one last chart I'll bring up here I thought was just an interesting chart that I'll leave you guys with before wrapping up was the U.S. personal savings rates. If you're a client of mine, you're a client of mine because you're either in the process of saving money, which you're doing a great job, or you've already saved money, which you've already done a great job. So this is more to give perspective and judgment on the rest of other people out there, so we can all judge together. This is a chart of the Commerce Department put together of the U.S. savings rate going back through 2023, which it was at beginning of 2024, close to 6.5%. Today we're at 3.5%. Which really is just, it's a sign that people aren't saving as much money. It's a lot of a sign that people are probably spending that money that they're making on a percentage basis, which if they're only saving 3%, they're really not, going to set themselves up for long-term financial success, which I see that a lot within my world where people are just not actively saving on a regular basis, which you have to do. And if you're somebody that's viewing this video and you're kind of trying to get your financial house in order, like saving 3% or honestly even saving 6% is way too little. Like you need to be saving at least 10 to 15% of your income to really be able to make a dent and long-term savings goals and retirement plans. And then it's not just saving that money, but getting that money invested, because if you just stick it in a savings account, you're not going to make anything. So I thought it was just an interesting chart that I wanted to bring up because so many of you out there have done a great job with saving. And so often there's always that comparison of like the keeping up with the Joneses of people that have this versus what you have, and that feeling of am I doing good enough financially? And just know that if you're working with me, you already did a great thing by hiring me, but you're also doing a great job by saving the money if you're in that process of actively saving it. And you're likely in that spot where statistically speaking, if you save the money and you're retired, you're likely in that spot where you're dramatically better than at least 2/3 of people out there if you're retired and living on your savings. So just know that you've done a good job, and give yourself a pat on the back for saving the money over the years. So those are the charts that I have for you this month, and just some of the insights of things that I've done and things that I'm looking at. If you have questions, feel free to reach back out to me, and we can set up time to do an investment review. If you're a client, you have somebody that's interested in having a deeper conversation with me, have them reach out to me, give them my info, or just put us together on a 3-way text, and I'd be happy to connect with them that way if they're looking to have a deeper conversation about their investments. But I appreciate you all taking the time to check me out. Until next time.